Hello, my name is Professor Daniel Broby, and unfortunately, I can't be with you because I have a bad back at the moment. I was planning to come, but unfortunately, you're going to have to make do with this presentation. What I'll do is I will try to keep it short so that essentially you have more time for discussion. And I would like you to consider what policy things need to be put in place to effectively enable digital currency in the future. So, when I say digital currency, I'm going to talk from a general perspective of both wholesale and retail central bank digital currencies, but also digital payment platforms and stablecoins. It's my personal view that stablecoins are underrated in as much as they provide a middle ground between the issuance of retail CBDCs by a central bank and effectively sponsored digital fiat money by banks or financial institutions, which I think will probably increase in importance going forward, and in some extent could even eclipse the even necessity for a retail central bank digital currency. But as I said, that's my view. That said, if you do go down the route of a central bank digital currency for retail, then you have to address something such as the legal tender status of that unit. Indeed, the legal tender status for crypto assets and or stablecoins, which is currently ambiguous to say the least. So a central bank digital currency, as you all know, is a digital version of fiat money. Uh, but what does that mean? It means that they represent an electronic liability of a central bank and fulfill these other functions, payments, transfers, and store of value. The debate is very much whether they should be token or account based. In that respect, a number of different approaches have been tested. And again, you probably know the testing on the wholesale market, Project Helvita and so forth, uh, as well as the testing in the retail market, largely done in China with the ECNY, which I have looked at in a research paper that has just been published. Importantly, if you're talking about implications from a policy perspective, obviously we all want to maintain the highest regulatory standards and we want to promote openness. In respect of competitiveness, we're in a very innovative environment. So I would add promote competitiveness. This is probably something which doesn't sit very well with a state sponsored currency. But obviously, we're in a world where there is competitiveness with stablecoins, with crypto assets. And therefore, we need to consider how these fit into the equation. In that consideration, fair and proportionate regulations have to be considered. So, for example, the EU has currently got a consultation currently out on the sort of fines that can be imposed on digital asset providers should they sort of effectively misrepresent or do something that in the promotion that doesn't fit with the regulations. The question there remains, is this fair and proportionate? Because we need to obviously ensure that, for example, in this instance, focusing and making tough fines on crypto assets also does the same on stablecoins, which would mean that obviously there's less incentive for banks and financial institutions to promote those. So we need to understand these distinctions in order to create the playing field that we want to support and engender. Likewise, this is an area where payments is essentially almost 2% of global GDP. It's the what makes capitalism, or even any other system, work for that matter. Now, in that respect, CBDCs, you could say, already exist. I mean, the payments are digital, and we do have real-time gross settlement with certain wholesale transactions. So the debate is focusing on where we're moving to, for example, atomic payment, and that atomic payment, in terms of doing things instantaneously, counterpart to counterpart, gets rid of counterpart risk. And that obviously is quite an interesting concept to build into money, so to speak. And the other thing you can build into money is smart contracts. And again, if we're going to allow smart contracts to be built into something as important as how we store money, how we transfer money, we need to be sure that that is thought about at the policy level, so that we're not reactive to something that has gone wrong because of something that has been programmed in to that money at some stage. And also compliance and data issues that need to be addressed. So the playing field that I mentioned is very complex at the moment. We have payment methods, and we have this divide between what is state-sponsored and what is decentralized, what is wholesale and what is retail. And from that, we have a whole range of digital payment platforms, whether it's between the banks, individuals, and or alternative methods themselves. So from a policy perspective, what you have is you have this very complex matrix of interactions that is currently poorly defined. And it's poorly defined from the perspective of what the implications are if things go wrong. And so there are three concerns in academia about what could potentially go wrong. There's the undermining of the efficient credit allocation, because effectively what we're doing is the central bank's balance sheets are more attractive than banks in the event that you can have effectively fiat currency sponsored by a central bank. And that obviously has financial stability issues, because at a press of a button, you can move to safety, flight to quality. You can basically press money from a bank and directly to the central bank, and thereby facilitate faster bank runs. And at the individual level, for the retail or whatever, there are a myriad of privacy and anonymity issues that I'm sure you are aware of. In terms of the credit allocation, central bank digital currency is a central bank liability. So in that respect, this distinction between wholesale and retail is important. The other thing that we have to understand is that obviously it's not the only central bank liability. And there are obviously many at the moment central bank liabilities. So all the concerns that a move to CBDCs will destabilize the system have to be put in context. So again, we can learn that from China, where we already have a legally recognized retail CBDC, the ECNY. In terms of just the outstanding M0 money supply, 9.6 trillion renminbi, relative to outstanding transactions of 83 billion renminbi in the digital space. So clearly not enough, even though this has been rolled out, not enough to destabilize the economy. But obviously the concerns about financial stability do exist, and mostly because the central bank is risk-free and therefore is seen as more attractive as a depositor than a bank. And so in that respect, how do we address that? Well, the literature has suggested that one way to address it is to have differential interest rates between essentially wholesale and retail CBDCs, and or uh, central bank deposits, and what the CBDC itself would carry. And in fact, most of the consensus thinking is that maybe the CBDC should not carry an interest rate at all, and therefore be more like cash in hand in its functionality. There are the privacy issues as well, and again, we can learn from China there. So, China is sometimes obviously criticized for privacy issues, and quite rightly so. But in terms of digital money and in terms of CBDCs, they have actually done a fair amount. They did introduce a national cryptography law to ensure that the protection was there for the CBDC as enshrined in law. And they effectively also have comprehensive national level data protection. In fact, they also introduced a personal data protection in the form of Personal Information Protection Law in 2001, which is pretty similar to the GDPR. So it's very easy sometimes to criticize, but there's whether whether the rule of law is upheld is a different question from whether the laws exist to protect effectively people using such instruments. And what is important is that they have put in checks and balances, and we need to do the same from the point of view of our central banks. Our central banks are currently very much in a debate as to should we or shouldn't we, whereas in fact they should also be thinking from that debate is if we do, then what? And that then what should include what checks and balances should we put in place. So that leads us to the policy recommendations, which, as I said, feel free to discuss after this short video. So clearly, what we've learned from China is that you need to recognize in law a CBDC if it's a retail offering. You need to better classify in terms of the rights and obligations of ownership. And in the UK, we're doing this. We are introducing, on a recommendation of the Law Commission, a new class of property, namely digital assets. And this is very important because it means that essentially transfer ownership and the sort of where possession and so forth falls is very relevant to the future of what's going to happen with digital assets. And that obviously is equally relevant for CBDCs. Clearly, if we are going to change the law, we need to differentiate between retail and wholesale level at the sort of law perspective, the law level, and we also need to then address the fact that we haven't really clearly defined this distinction between what decentralized and what centralized actually is. So in that respect, if we are going to do this, what we need to do is we've got to make sure that privacy backs up trust. Banking is all about trust. Accepting a fiat currency is all about trust. In fact, if you look at the US dollar, it actually has written in it, "In God we trust." So in that respect, we need to enshrine in the legislation something that will give people confidence that this digital asset that they will have will remain their digital asset unless they transfer it legally to another party. We've also learned from China that there needs to be a testing environment, and that testing environment should be protected from unnecessarily regulatory burdens in much the same way that we do with our sandboxes in terms of trying out new fintech innovations. We need to do the same for how we test CBDCs. We also need to put thought to the national digital infrastructure. Essentially, if you're talking about people's money, you don't want to have a situation where the infrastructure fails, you can't make a payment, or where worst comes to worst, your server goes down and you need to have a disaster recovery plan on that. So we need to have a very robust digital infrastructure. Now, the telecom infrastructure is robust, but on the other hand, it is and can be improved upon. And obviously, you don't want to go down when it's your money that's at stake. As I said, in terms of the financial stability, we need to decide, or central banks need to decide, like the Consob needs to decide whether or not a retail CBDC would be interest bearing, and then what the policy are in place to determine that. So there would need to be a, for example, separate policy decision when setting the policy rate for digital money as opposed to the money for banks putting money on deposit directly with the central bank. There would also need to be effectively in the law that gives this legal recognition to the CBDC, essentially a reference to its roles in terms of its medium of exchange and its exchange mechanism. And in that respect, it's got to do that in a technology agnostic way. And again, coming back to the UK and what we're doing in the UK with regards to this new class of property in law, we have had to write it very carefully in terms of the way that it is technology agnostic as to the future direction of the way that digital transfers will occur. We also need to think about the delegated powers, so delegated powers of regulation, of oversight, and so forth. And that obviously needs to be enshrined in law. And as I'm sure many of you will agree, a degree of independence is obviously preferable in that respect. Imagine a situation where an oversight body could effectively cancel digital money, which you could do at the touch of a button. Obviously, that doesn't engender trust. So that's why it's necessary to ensure that the delegated powers have a degree of independence. I've talked about the fact that you can include smart programmability into digital currencies, but obviously that's not just a good thing to have in terms of the fact that we can automate things like settlements and so forth in the future, but it's also a dangerous thing to have. And therefore we need to think about how and when that ability can be added to such instruments. Crypto assets, cryptocurrencies aren't going to go away. So obviously, if we're going to address this in law, we may as well address the ambiguity there between these various instruments. And then finally, we need to think in terms of how secure these assets are, because as we know, there are cybersecurity issues in a digital world in all aspects of everything we do, and will be more so when we actually have digital money. So we need to think through things like the zero trust approach, and also think through how the multi-layer defense strategy from a cybersecurity perspective works in terms of the CBDC infrastructure. So there you are. I've written 2 papers on this: central bank digital currencies, the policy implications, and also the lessons from China. And that's, as I said, just a basis for discussion. And once again, I'm very sorry that I couldn't be with you. And especially, I just received the invite for the dinner at the Marriott, and I'm very jealous. Thanks very much, and have a good discussion.